Now, the debt crisis in Europe, it continues, and now AXA investment managers say that Portugal is going to be accepting a financial bailout within the next few weeks. Now, the country is raising taxes and also implementing its deepest spending cuts in more than 3 decades. But Standard & Poor's said today that its debt rating remains at risk and it probably will be cut. But what will a bailout mean for the European Union and its shared currency, the euro? Joining us now, Axel Merk, Chief Investment Officer for Merk Investments. He oversees about $500 million in currency-focused assets. He joins us now from Palo Alto, California. Axel Merk, good to have you with us. Why do we care about what happens in Portugal? I mean, it's a small peripheral country. If you're in Portugal, sure, we understand it's important, but why does it matter for the rest of the investment world?
Hi, Pimm. Hi, Julie. Well, the theory has been that the peripheral countries' woes may affect the euro as a whole. Now, I've been on your program and argued that indeed the woes of Portugal should be priced into the Portuguese bonds and not into the euro. The reason why they have been were priced into the euro, especially last year, is that it's not so easy to short Portuguese government bonds. You have greater liquidity in the euro, and if that trade works, by all means, when there's a crisis in the eurozone, you short the euro. We have been arguing that the euro can actually thrive on this. And indeed, we're now at 138 rather than below 118 in the euro. And the reason is that it's more difficult to spend and print money in the eurozone. Ultimately, the Portuguese problems are those of the Portuguese, but the concern is, of course, it's going to spread over to Spain. We think Spain is in a very different situation. And we think that Portugal is going to be very reluctant to take money on if they take it on at all.
How deep is the hole, though, whether you talk about Portugal or continuing issues with Greece and Ireland as the EU continues to bail these countries out? I mean, even if the number of countries is limited, are you going to end up throwing sort of good money after bad here?
Well, of course you are. The question is, of course, how much social engineering do you want to do and so forth. And by all means, the cost of borrowing is going to go up over time for the stronger countries. The thing is that Germany doesn't just want to throw the money away. They want to get something in return. Now, having said that, the Portuguese in particular, they have argued, well, not only we don't want the money, and precisely because it doesn't really help us, because the other countries, their cost of borrowing hasn't gone really down. They have been shunned from the capital markets, and their CDS hasn't gone down. So unless there's a real improvement by accepting help, there is no sense in taking it. The Portuguese are much better in managing their debt needs. So if they want to, they can stick it through. Having said that, of course, if they see a great benefit, they'll change their mind. The Germans don't want to throw good money after bad, and they want to negotiate